Good morning, everybody. It is Friday, May 30th, month end, and we are going to start our prep today. We'll start with reviewing what happened yesterday and how you could see this in Globex after NVIDIA earnings and what you can do moving forward. So we talk about our insurance and our washing machine, and you can see as we came into Globex after NVIDIA earnings on Wednesday into Thursday, we had a lot of insurance that had been bought. Now, remember, the insurance can only be during when we have the liquid periods and the business is fully open. So that's typically during RTH hours. So everybody had to buy the insurance for Thursday. So after the earnings come out, we get the tariff pause, which has now been resumed. But the positioning says that there are a lot of insurance policies. And as we've said, once that insurance demand is gone, and we know that no more is going to be bought because NVIDIA earnings are out and the market is essentially closed. This is where those insurance providers can move the market up and mark up as high as they want, knowing that in the overnight session at 8:30 when liquidity starts to come in, 7 a.m. when pre-market trading starts, and 9:30 when RTH opens, all of that insurance is going to get closed out. And so they can devalue those policies to make all of their money. And that's what we saw happen. So that big markup on lower volume, right to some areas that we have as key levels and where we know our market makers had billions at exposure and would begin to introduce a lot of supply. We started selling down. Now, how could you use this? Yesterday, we told you the rotational high was at 70. You could have shorted right at the open. We also gave you 44 as a key level. You could have been looking short there. Um, there were many reasons that that move up, if you're looking for that continuation of a buy, is not likely going to come in. It was just insurance. And once that was gone, there wasn't anything left to hold us up. So that's what happened is at the start of yesterday. And we held all of our levels, really kind of as expected. So that's all we had really for yesterday on for you. So now, before we start today, quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So we will get new data, not today, but on Monday. Because of the holiday on Monday, the COT data will be delayed from the CFTC. So all that we know and all that really matters is commercials are still long. So we get our green box here telling us that we have a score that is worth um, a buy signal, and we are just seeing that upside push through. On to high yield, we are still below our 3.5 threshold, so we're just still again on watch for now. If we fail to get over that 3.5, then it says more complacency in the market. If we start to get over, then there are more risks present. But nothing has changed here. Same on bonds. Bond vol is still signaling complacency, but almost too much. So we'll be watching at the start of June in the next week or two for bond vol to pick back up and see a spike come back in, which will lead to either sideways or a little more downside in our equities. And now on to cross-asset volatility. We're still watching for the VIX to break under 18. It is a little more elevated this morning. Uh, and volatility is going to be on close watch over the coming days and weeks. We are still waiting to see what happens with the tariff resolution. We are waiting to see, what happens after the next business cycle closes, which one will be today and one will be in a few more weeks. And until the volatility really starts breaking down below 18 and then below 15, this market has risk still in it. So don't just assume it's always going to go up, as we saw yesterday. There are risks inherently positioned in the market with this. And we see that in our systematics. There's just uh, no engagement from this group, and that takes about 500 to $700 billion out of the market, and it's just on the sidelines. It'll be a while, just like we saw back here, where we had 2023, it started to come down. We had a much more sustained rally. This rally, is looking again back to what 2022 looked like, and that won't change until we really start seeing our red line getting below our green line. Now, another thing that we look at is the underlying cost of doing business, and those are starting to tick higher. And we saw that play out back in February, back in December, back in mid-January. When this blue line starts ticking up, that tells us the cost of business is increasing. So that brings the potential for downside, for repositioning, for higher costs of insurance, premiums in the market. And when the yellow is above our zero line here, that also tells us that things are accelerating. So that again brings more downside risk. So then once it gets below zero and then risks kind of come out. So we still had the blue over. So there's still risk, but it's a little bit less. Once the yellow starts ticking back up and over, that's when we saw the big down moves. And then when it started breaking back down, that's when we had our 9% up day. The cost of business matters because as a retail trader, we don't think about it this way, but the business side of the market has to always maintain a neutral position when they're market making and when they are hedging their books. They don't want to have actual directional exposure. They are trying to maintain a more neutral position and capitalize either on the premiums, the spreads, or the inverse relationship between instruments. And so when this cost of business starts rising, that means a lot of repositioning is going on and something is out of line. So the business changes. Then we see it breaks back down. That becomes much more supportive starting pretty much after that Trump tweet on today would be a great day to buy. And it became very supportive, and we can see that. But then we started to see it come back up, and that led to our downside. And we saw the blue line tick higher, and that led to our bigger down day earlier this week. And then we saw or last week, I mean, apologies, that was on the 21st. And then we had, again, the blue ticked under. We came back down to zero, and that was much more supportive for the bigger up move on NVIDIA and back to our positioning that there was too much insurance in the market, much easier to do a markup. So that's what's happening under the hood in the market. Uh, and how you use that is understand what is likely going to happen, what the business side is going to do. The same way if you were working for a retailer, you would know what products are coming in, what the sales are going to be. You could let your family know in advance. We're looking the same way here, trying to figure out where the edge is, who has to do something. When we're talking trillions of dollars, somebody always knows something, and we are capitalizing on that. How we do that is again back through our levels. So for today, we are looking for a rotational price action from 50. Uh, you can see right here. So the blue to the blue is what we're looking at for rotational. And that is going to be 58.72 to 59.53 with our minor line in the sand at 59.20. And our major line in the sand is far below us here, this pink line here at 58.51. And our pivot inside of our zone, so this orange level here, is going to be at 59.09, 59.10. If we get over our rotational high today for a month-end markup, we would look for 59.94 to 6,018. That's this orange and red up here. And the lower levels would be 58.31 and 58.07. Some other key levels for you to pay attention to today are going to be 59.68 3/4, 59.56, 59.34 half, 58.89 quarter, and 58.67. The biggest ones to pay attention to are going to be 58.89 quarter and 59.34 half. Those are the two that are kind of framing our price action right now. You can see that in these yellow levels. The upper yellow at 34 half really hasn't changed much this week. That has been a key level all week. And then this one down here at 89 has oscillated between like 87 and 91. We get very precise because, again, as day traders, we are trying to capitalize as much as we can. So precision matters. And on to, and you'll be able to see your levels here as well for our subscribers. If you went to the Stix website, you will see our levels here. When you scroll over, these are just my personal levels for the ES today. Onto the NASDAQ, we are looking for rotational price action 21,565 to 21,217 quarter. Our pivot is 21,389.75. If we get over our rotational high, and we'll look at the ES to do the same at that point, 21,736 to 21,841 would be the targets. And if we do have a breakdown today, 21,040 to 29,36. Now, the big sign here is our line in the sand, our purple line there is just inside our lower rotational zone. So now that is telling us that unless the market continues a push higher, we are going to start seeing a more likely turn down. And that's when that becomes inside of our range, that becomes a distinct possibility. So it's at the very low end, so not likely today, but we will be watching that if it starts to rise higher and our ranges come down. On to oil, nothing has changed here. So are still looking for rotational. Bigger picture is better to focus on 55 to 60, 63.74. That's going to be your bigger levels. 55, 60 is really where we're going to watch. Um, Inside of there, you can trade some of these edges. Again, we have our zones for today, and we are over our line in the sand at 59.82, but uh, oil has just been very range bound, and we're not seeing any geopolitical risk then priced in. We're also not seeing any inflationary pressures at the moment. And then lastly, on to gold. Again, similar to oil, very range bound. This is the M contract here. So if you have rolled over your contract already, just make sure you adjust your numbers. But the big sign here is our upper range expectations up here at this 34.65 to 33.89. That resistance expectation is a lower high. And so that tells us that we know market makers will be selling a lot there. And that is not leading to a breakout. So today, not looking for a big month end markup on gold, at least not to a new all-time high yet. But we want to be watching again, just like with the line in the sand on the NASDAQ. If this keeps moving lower, where the dealers, where the commercials, where the market makers, that side of the market will introduce a lot of supply, then we are going to start looking for gold to break down and break under 3,200 and 3,100 to come back to around 29.50 to 28.75. So that's what we're looking for today, guys. And as always, control your risk. It's month end, but every day, if your focus is on minimizing your losses, controlling your risk, and building out your edge, then when the big trades come, you'll be able to capitalize. You don't want to lose everything, get knocked out of the game too soon. So have a great weekend, everybody, and we will be back on Monday.